Today, we are talking about SPACs. Spackety SPACs. What are they? What do they mean? How do you get involved? Should you get involved? Let's get right into it right now. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Thanks for tuning in. We're talking about SPACs, special purpose acquisition companies. Today, before we get into it, take a sec to subscribe, give us a follow, give us a like. Love to hear your comments on this topic or anything else, because SPACs are truly taking the world by storm right now. Never have I heard so much chatter about SPACs. They're rolling into hundreds and hundreds of millions of dollars, which was never the case back in the day. These blank check companies really have taken off. Let's get right into it. So a special purpose acquisition company, SPAC SPAC. It's a company with no commercial operations, and they're formed strictly to raise capital, and they do it through an IPO, an initial public offering. And the sole purpose is to acquire an existing company. These are typically called blank check companies because you do not know what you're getting when you're investing in the SPAC. So the SPACs have 2 years to complete an acquisition, or they must return the funds to the investors. At the time of their IPO, SPACs have no existing business operations, or they don't even have stated targets for the acquisition. The founders of the SPACs sometimes have an acquisition target in mind, and they might kind of let that leak out, but they're not supposed to identify that target during the IPO process. It's effectively a blank check. The monies that the SPAC raise in the IPO is then placed into an interest-bearing account. Those funds can't be distributed unless you are acquiring a company or you return the cash to your investors. All right, you give this money, effectively a blank check company. They go out, they have 2 years to acquire an actual private company. So why are they so hot lately? They've been on fire. And why? Well, it's effectively, one way to put it as it's like kind of poor man's private equity funds, right? Like it's a way for anyone with $5,000 or $2,000 or $50 to get into kind of the private equity market. Private equity traditionally is for companies that are private, so they do not trade on the public exchange. Anytime you hear the word private equity, this means companies that are privately owned, meaning a group, a family, any kind of size of investors, but the stock does not publicly trade. Okay, so that means it's private. Public, it's on the markets. Private, it's owned personally, not publicly traded. So everyone wants to get into private equity. There's a ton of research that shows that private equity outperforms public equity for a bunch of reasons, but generally they don't have the limitations, the restrictions. There's a lot more they can do. It's cheaper to operate. They can be way more lean, etc. SPACs, they continue to exist because it gives the ordinary investor a way to purchase a hot company before it goes public. So that was typically reserved just for the wealthy or the extremely wealthy. And it does make sense because the venture capital world, whether you're talking about startups, right? You've probably heard of this. Oh, we're doing startups. We're going to make millions and millions of dollars. Startups or late venture or pre-IPO, all of these terms are used for private equity, and SPAC fits kind of right in the middle of that. Hey, by the way, guys, on this topic, if you want to learn more about this, go to www.speaktorob.com. Love to book a no obligation consultation with you to chat about this, how it fits in your portfolio, how SPACs, what percentage allocation, what you should have. Happy to chat about all this. So last year there was a boom, okay? And this year, first, call it 2 months or so, 188 SPACs went public. They raised $60 billion. And this is obviously, they're on pace to crush last year's record, which was around $83 billion. So we're raising money at a much faster pace. There's way more dollars being thrown into this. And why? There's some thoughts about this is that this is partly kind of the younger generation, the Reddit community trying to get involved in this. But I think it's just appetite. Whenever you get into a market that kind of becomes a little frothy, you start to get that appetite for more returns, right? It's partly greed, right? We want to get better returns. I made 15% in my stock portfolio. That's not enough. I want to make more. So therefore, how do I get better returns? Well, you go down the risk or up the risk scale, right? And down the credit line. So down the publicly traded line, you go towards private equity. You increase your risk, and therefore that's the appetite right now. We're seeing that en masse this year. So it's about 60 to 70 billion already raised so far. So remember, you got 2 years. You're typically trying to find a large IPO. The average SPAC generated 335 million last year. So these are hundreds and hundreds of blank check companies. They're looking for private firms valued at $1 billion or more. Typically, they're looking for value plays. So you might see stuff in energy, industrials, finance, whatever it may be. But now, that was kind of historically. Now we're seeing fintech. We're seeing healthcare. We're seeing e-commerce. We're seeing electric vehicles. We're seeing commodities that deal with electric vehicles. We're seeing all of that that happen right now. They're on fire, right? So there's also the cannabis place. So there's a whole bunch of SPACs currently that are looking for cannabis startups. Now these, who knows, there's also e-gaming. We know DraftKings trades at $60 a share, give or take. That's a threefold increase from their debut about a year ago. There's always going to be guys, gals, institutional investors, retail investors that are looking for the next big thing. And that's why you're seeing SPACs on fire lately. So I will tell you this, if you're considering investing in SPACs, make sure to talk to your investment professional. Make sure, talk to us, go to www.speaktorob.com because you got to be careful. It's incredibly speculative. Because you're writing a blank check company, management is incredibly important. You want to know roughly what the target is, where the sector is that they're going to be targeting, and you want to know the timeline. When you're investing in a blank check company, you better be darn sure that you're comfortable with whatever they end up buying because you really don't have a say in it. Then they typically do the IPO. That's when you can decide if you want to top up or reduce your position. And hopefully you're getting an exit after the IPO for a much, much larger gain. But I can tell you this, a lot of these SPACs are not going to make money. A lot of these SPACs are going to fall on their face. A lot of them are going to generate negative returns for the investors. So just be extremely careful. It can fit in your portfolio, but it's extremely high risk. It's extremely volatile. And if you're going to be doing some, just make sure you're willing and ready to lose all of that. And if you are, make sure you understand and appreciate the risk that comes with that. All right, guys, I'm Rob Tatro. Go to www.speaktorob.com to book a chat about this or anything else in your portfolio. Rob Tatro from robtatro.com, portfolio manager here, Canaccord Genuity Wealth Management, and the Tatro Wealth Advisory Group. Thanks for tuning in. I will see you in the next video.